Hello, and thank you for joining me in another video. And today we are once again talking about Nebius stock. But first of all, if you are new here, my name's Howard. I'm a retail investor of over 10 years now, and I recently started this YouTube channel to share my investment research and actions. So if you're a retail investor yourself, please do subscribe and follow along. And also, if you're not new here, thank you for joining me again for another video. So let's get into the topic of today's video, which, as I mentioned, was Nebius stock. And after us having a really good run last week and breaking comfortably through the $100 mark, and did a video about that as well, we were hit very hard again Friday. All of the AI data center stocks and in general a lot of growth stocks on top of that were hit. So if we'll start off, we'll go into specifically what happened to data stocks or data center stocks in general, because we had some news from CoreWeave, which I think set the ball rolling for a bit of a sell-off in data centers. And then we also had a broader market sell-off in growth names as well, with what happened with the tariff ruling. So we'll get into all of that. First of all, we will check into on the stock price. So as you can see, we are having a really nice run last week, all the way up to sitting comfortably at around $107. And you can see we finished the week down just under $98 as well. And if we look at the last day, you can see we really were just kind of trending down all day, and down 9% in total. And if we check that with, if we go back to, let's check CoreWeave first. Again, we can see they were down 8% on the day. They got hit really bad. You can see the sharp decline there that they actually had, kind of falling off of a cliff. And again, the other main one, IRN, as well, down 7.6% on the day. And this is on top of other growth stocks as well getting hit with the broader market news. So what actually happened here? Well, after us going really nicely for the rest of the week and getting a lot of strength, we did have some bad news come out, and it does always seem to be timed very well, this news coming out. But it's basically some reports. We've got it here, we've got it here from the Motley Fool. We've also got some other news reports going on this as well. And it's basically the idea that Blue Owl Capital is having trouble raising capital for its investments in CoreWeave. And we'll preface this with this: people are making a lot of big kind of news about this. But it has also been said already that both Blue Owl and CoreWeave say the project is fully funded and construction is proceeding on schedule. So from their standpoint, this is all overblown. But what I think it has is kind of raised the idea once again, which always happens with AI, with the amount of money that has been spending. People are always going to get scared of the amount of money that's being spent. Why? Because we need to see that there's going to be an ROI of that in the future. AI is really useful already. We know it's a transformative technology, but people are spending so heavily. We really need to see this bring use to human beings and bring economic benefit for all of this spending to be worthwhile. And so always on the bear case of AI, which is not me, I'm very bullish on AI, but the bear case is always going to be, are we going to see the benefits from it? Are we spending too heavily? Should we be even raising debt? And debt is what we're getting onto here as well. So well and good spending your free cash flows and investing in the future, but when people are actually borrowing money and investing, buying debt, that's when things get a little bit more scary. So even a little bit of news like this, like Blue Owl Capital is having trouble raising capital for this investment, it gets the market a little bit spooked. Are we getting ahead of ourselves here? And should we be spending this much money? If investors are actually, is this suggesting that investors are actually getting a bit tentative and are not willing to allocate billions of capital in every single project? Is this a sign of us hitting the top of that? I don't think it is. Blue Owl and CoreWeave have already announced that there isn't any problem with funding with this and it's going ahead. But again, this just seems to be something that has spooked the market a little bit. And for those who don't know, Blue Owl Capital is like basically a capital money raising business, basically, and they do these investments with companies such as CoreWeave. We've also got another one here. You might have heard of them before because they also partnered with Meta with funding this $27 billion AI data center project. This was towards the end of last year, and they help raise money to invest in big investments like this for driving businesses forward. So overall, the news, basically everyone got a little bit scared on, are we borrowing too much money? Are we having problems actually borrowing that much money? I don't think we are by the looks of it, but it does just make the market a little bit tentative. Are we getting ahead of ourselves here? And if we're getting ahead of ourselves, that would signal money drying up for the AI investment thesis, and it won't be good for the AI stocks. Then let's have a look at, okay, does this actually affect Nebius, or this idea of borrowing so much money, does this affect Nebius? So I've gone over here to look at the charts of Nebius, and what I've got here is a couple of numbers. We've got total debt, it's the amount of debt that each company has, and we've also got the debt to equity, so how much debt they have versus like as a ratio of the equity in that business. And I've just got Nebius and CoreWeave here to compare each other, because Nebius is the company that I'm invested in, and that's what we talk about here. And it's good to see how that compares to CoreWeave, because to be honest, it's a different business and it has a very, very different strategy. CoreWeave, make no doubt about it, this is a transformative technology to them, AI and AI data centers. They want to build as many data centers as fast as possible, and they are very happy with borrowing and getting into as much debt as possible to do that. You can see here they've got 18 billion worth of debt at the last Q3 versus Nebius's 4.5 billion, and their debt to equity ratio is all the way up there at 4.8 versus Nebius at 0.9. They are borrowing a hell load of money, and they want to keep on borrowing money because this is the future in their eyes, and they want to be building as many data centers as possible. And that capital or that debt will pay them back in abundance because of the value it will provide. And it's not really a bad strategy. Like, people have a bad negative connotation towards debt. At the end of the day, a lot of debt fuels growth. If you're very confident in the growth of something, then you have debt. Property is something that we all can touch and feel. We know property in general has been a very good investment. For everyone that owns property, they more than likely have debt. For people that have a huge portfolio of 20 to 100 properties, they also have a huge portfolio of debt. Because capital appreciates much faster in general for a property, you're happy to borrow money from the bank at a fixed interest rate because you're going to invest that and get a better return higher than that. So it might as well just borrow the money and grow even faster. And it's the same here when we're talking about these data centers. It's potentially such a huge benefit, the investment in the future, that it's worth to just borrow money at a fixed percentage now because it will pay back. So I just wanted to show you here just what we're looking at in the scale of things when it comes to debt, and why these fears about borrowing money to build, I think, are overblown anyway, but especially this is going to affect CoreWeave much more than it's going to affect a company like Nebius. This is a specific problem to CoreWeave much more than it is Nebius, because they are relying so much on raising as much debt as possible. So if there are any cracks possibly forming in their ability to raise money, that is going to be a much bigger hindrance to them than something like someone like Nebius, who doesn't borrow as much money, but of course they are going to get dragged down with the narrative of that. So that kind of shows where we lie on the numbers side of things. And then we're also going to look into, again, Nebius. What's Nebius's strategy on this? So Nebius does have debt, as we've just seen, and they're not ruling out getting more debt. As I said, this is a great investment. As long as our theories play out, it's a fantastic investment. We want as many of these data centers as possible so we can continue to grow revenues in the future. But Nebius is not as explicit about getting as much debt as possible. And in fact, in their recent Q4 earnings, Arkady, the founder and the CEO, mentions one of the most important things for the business. To achieve this, we will be focused on 4 key strategic areas: scaling capacity with discipline, executing on our customer commitments, advancing our AI cloud platform, and raising capital strategically. One of the core pillars that they need to be executing on is simply raising capital. That is one of the big important things for them, raising capital strategically and basically as efficiently as possible. We've got very normalized in the idea of spending billions and billions and billions every single year on AI, and we forget just how much money that actually is. So if you can raise capital efficiently and making those small percentage differences, that is a huge amount of money that you're saving, and ultimately being able to reinvest back into your business to grow even faster. Raising capital is a real strategic difference in this game when you're spending so heavily. And how are they raising capital? They also share this as well in what they're doing. We will maintain a disciplined approach to raising capital, not trying to get every single bit of money at all that they can get their hands on at whatever interest rate. They're being disciplined about this. We see a strong appetite from financing partners and investors, and have a broad range of financing options available for 2026 and beyond, including corporate debt, asset-backed financing, and unused at-the-market equity program, which is, of course, selling shares into the market. They do have the ability to do that as well. We also know that they own other businesses as well. If we go up here, we've got AV Ride, Triple 10, ClickHouse, Toloka. they would also possibly be able to sell some of their stakes in these businesses like ClickHouse, for example. I personally do not want them to do that. I would much rather them invest in these startups and let them grow, because I think there's a lot more potential growth from that as well. So raising debt or issuing or raising money through sale of shares is something that could possibly happen. So that's what I wanted to go through in today's video. Basically go through what happened with that little market blip when it comes to data centers. And it does look that it's due to this concerns about fundraising or raising capital and raising debt, even though it looks like there isn't actually a problem with this particular scenario of raising debt with Blue Owl. It has just makes people worry a little bit, and it gets people thinking about the negatives a bit more, and it causes a sell-off like that. In my personal opinion, that's what's happened anyway. And even if we are talking about raising debt, yes, Nebius does have debt. It probably will continue to get more debt, and it needs to get more cash to build these data centers. But Nebius is not going fully leveraged on debt. That's not their strategy. It's very different from CoreWeave, and they're kind of playing in two different markets on that standpoint. So I do think this affects Nebius much less than someone like CoreWeave as well. So that's it for today's video. I hope you found it useful. Just want to give my opinion on why it sold off, and also how I think that affects Nebius, which I don't think is very much at all. We've got an exciting week ahead. We've already been kind of very choppy over the weekend. If you were to look at like Bitcoin, and that, although we're not investing in crypto, it does show kind of what speculative asset is doing, and it's very bumpy at the moment with the things that are happening in the macro market with kind of the Trump tariffs and stuff like that. We also have some big earnings this week with the likes of Nvidia. And if Nvidia struggles, then it will be hard for other AI companies like Nebius to do well as well. So going to be keeping a keen eye on those. Apart from that, if you have any questions on this or your thoughts, please do let me know in the comments. I'd really love to hear your opinions on this as well. And apart from that, I will see you on the very next video.